Good morning and welcome to today's 5 with Fitz. You know, all the major averages are in the red in the early going as the entire world waits for trade deals and yet another Fed decision. We have seen this playbook so many times. Do not let the short-term noise scare you away from great companies, especially today, and do continue to lean in. Why? Because the markets are the only store on earth where people fear a sale. Here's my playbook. Number one, Palantir rocks it again. The company reported Q1 earnings yesterday. Total revenue grew by 39%. U.S. commercial revenue grew by 71%. The Rule of 40 increased 83%. And it closed a record 139 $1 million plus deals, raised fiscal year 2025 guidance sharply across the board. Yet, Palantir shares are falling today on the heels of an after-hours rug pull that I explicitly told you yesterday was coming even if earnings were great. See number 2 yesterday. Now, this confuses a lot of folks who don't understand how the game is being played in the big leagues. Investors like us, yep, you and me, because I'm one too, are buying stocks we believe in. Wall Street's big money traders have one job, and that's to make as much money as fast as possible by separating you and me from ours. So don't let it happen. In other words, you're buying the future in a great company. They're buying and selling your emotions. So keep it stupid simple. Remember that there are always sharks in the party pool, so don't be the bait. Simple as that. There's a chart that I printed out in today's written version of the 5 with Fitz. Look it up, get it out of your email, cut it out, tape it to your mirror, to your monitor, even your forehead if you have to. Days, weeks, years, decades, they all have very different perspectives because profits and price and perspective go hand in hand. Now, my Palantir price target remains $200 in the next 12 to 24 months, perhaps a lot sooner. Keys investing tip. It is hard not to let short-term action bother you, and I get it, but that is exactly what you want to do if you're going to be a successful investor. Not for nothing, but I struggled to learn that too, so I know how hard it is to learn the lesson. You got this, I promise. Just stick with it. Be sure to check your email, by the way, if you're an OBA or immediately regarding Palantir. I sent out some revised instructions earlier this morning, and it's time to take action. So, hoo-yah if you're on board. Number 2, DoorDash. Is that a platform in disguise? DoorDash announced 2 separate acquisitions: British food delivery giant Deliveroo for $3.8 billion and US-based restaurant tech company 7Rooms. Now, the terms were undisclosed on that one. But what's the play here? Seems to me that DoorDash is laying down the digital rails for local commerce the same way Amazon did for global goods. Now, Deliveroo adds 7 million users in a major European footprint. 7Rooms gives DoorDash in-store tech firepower, CRM, loyalty, operations. Together, this isn't just about food, it's about owning the restaurant lifecycle. Online, offline, dine-in, delivery, every channel, every touch point. Now, should you buy it? That's the interesting question. It's tempting, but if you really look at this, and I mean really look at it, this is N+1 at a time when 0 to 1 is the better play. And if you don't know what those terms are, get Peter Thiel's book, 0 to 1. It is mandatory reading for the OBA family, and I would encourage you, if you're in the 5 with Fitz family, to read it anyway. I prefer another choice that's already well on its way to mastering what I call the full stack strategy. Shares are down about 5% or so far since I bought in, but that's okay. You know, I expect shares to double if my read on the situation is correct. And if not, I've kept my risk small to begin with. Number 3, Ford. Now we have something to blame. Ford is dangerously close to becoming the Intel of automotives. Bloated, outclassed, clinging to narratives that Wall Street's happy to sell you. Ford's decision to yank its 2025 guidance isn't about tariffs. I know that's what the media says, but my take is that it's about cover. Management attributed a potential $2.5 billion tariff impact to Trump's trade proposals, noting they expect to offset about $1 billion, but said that the remainder introduces too much uncertainty to maintain current guidance. Okay, fine. But the truth of the matter, at least from my vantage point anyway, is that Ford was already getting squeezed by superior Chinese EVs, Tesla, bloated legacy costs, margin structure that doesn't hold up in a high-stakes protectionist environment. Now, Ford says it could have done $7 to $8.5 billion in EBITDA without tariffs. But the translation is, hey, we're going to miss now, so now we have something to blame. Again, same old story here. The company is halting exports, scrambling supply lines, hoping the White House changes its mind. That is not leadership. It's spin control, damage control. Now, I want Ford to do well. I mean, I love the Ford brand. I love my GT40. I love the Cobras. So many things about the company. But let's be honest. I'm not going to waste my time as an investor or my money under the circumstances. There are a lot better choices out there. And you got to constantly keep that in the front of your mind. Two of my faves, for example, have returned 450+% and 740% approximately over the past 5 years compared to just 165% from Ford. Now that's enough to turn $1,000 into 5,500 plus, 8,300 plus respectively versus just 2,600 from Ford over the same time frame. So here's the thing you want to think about. Too many investors collect stocks, and that's fine if it's what you want to do. I personally would rather focus on winning. Why? Because missing opportunity is always more expensive than trying to avoid risks you can't control. And the companies that blame the dog for eating their homework, like Ford. Anyway, number 4, currency moves faster than politicians every time. The Taiwanese dollar just pulled a 1981 style stunt, plus 9% in 2 days and down 3%. Now that's not FX noise like a lot of people think or the media is reporting. Exporters dump the US dollar, insurers hedge, but whispers say the real driver is a silent currency realignment being driven by US trade talks. Now officials deny it, but once again, the people working with real money, the traders, don't. Taiwan Semiconductor is down 2% on Q. Might be an interesting opportunity. The investing tip here is very simple. Currency moves don't lie, but politicians typically do. Anyway, actionable idea, look for the inverse Taiwan ETFs like Yang or short duration puts on FXI TSM if volatility picks up. And finally, number 5 today, the House of Mouse. Disney has a lot going for it and a lot that, well, isn't going for it. It's been a long time favorite for many investors, but it's long gone from my buy list. The key, as it comes in earnings, is going to be streaming, which I think will be growing faster than the bottom line. Now, I could make the case for buying shares if margins expand, and there's a sense that management knows how to keep that going as the economy tightens up. But I probably won't. I wish I could, but I won't. Anyway, bottom line today is something very simple. Wannabes want to be right, but successful investors want to be profitable. There's a big difference. As always, let's make it a great day. You got this, I promise, and I will see you again tomorrow. Thanks for spending a few minutes of time with me today. See ya.